we can't have a generational gap that exists between the founders, the market, as well as the investors. Taxation doesn't become a form of security or defense for that matter. I think that entire thinking is actually fundamentally flawed. We need to differentiate between regulation and over-regulation. I think that's a very fine line, because over-regulation is always antithetical to innovation and progress. And innovation always outstrips regulation. And unfortunately, in certain times, not just in India, but across the world, the regulators end up actually over-regulating that particular industry, thereby actually killing any sort of innovation that can come about. To the moment you have a more freer economy, the moment you have this sort of easy flow of cash for that matter, the more attractive you actually become from an economic perspective. So it's not just GDP, it's consumption, it's a trust that people actually face in the government for that matter, and the ability to end up absorbing these large capital flows coming in. I think those are the fundamental constituents. And if any country ends up meeting that, there's a good chance it can end up actually becoming the global currency going forward. See, the tension between this sort of legacy issues and those bad actors versus the new economy that's coming in, India is still in that transition phase as we speak. Given the fact that, venture is not something, what worked in venture 10 years ago is not going to work as of now. What works as of now is not going to work 10 years later. So if you have 20, 30 years experience, mind you, some of the experience ends up actually becoming legacy baggage as well as biases that are actually inbuilt. And a market that ends up changing every 2-3 years, you have to end up actually keeping yourself refreshed.
Hello and welcome to another episode of the KVKurious Podcast. Our guest for today is Siddarth Pai, who is the founder of 314 Capital. Siddarth is a chartered accountant by training and currently serves as the executive council member of Indian Venture Capital Association. He's also an expert of policy who works with initiatives like iSpot. In this conversation, Siddarth throws a unique perspective around how startups, founders, and in general, people need not fear regulations, and how regulators at any given point are always willing to hear people's requests and constantly work and innovate their way through making life, business, as well as any kind of commercial activity very easy and possible within the country. Especially if you're a startup working or a founder working in a regulated space, like let's say fintech, you might certainly want to listen to this conversation with Siddarth and perhaps gain more confidence in how easy it is to take regulated approaches to building long-lasting businesses. I'm sure you'll love this conversation. Stay with me. Listen to Siddarth Pai on the KVKurious Podcast. Hi, Siddarth. Thanks a lot for joining my podcast. Super excited to speak to you about what's happening in the Indian startup ecosystem around angel tax, around valuations, and so much more. So thanks for joining me.
Happy to be here. My pleasure.
So let's start with the hot topic going on right now. What do you think about the recent angel tax regulations and new valuation methods that have been prescribed?
So I think the way it's actually gone about. So I've been fighting the angel tax issue for quite some time. And for the benefit of your listeners, I'll just explain what it is. So angel tax is basically a uniquely Indian invention. What it seeks to do is for any startup that's actually raising capital, which ends up issuing shares. Normally the shares are issued above the face value, and that's a share premium that's there. In case of a difference between the issue price, the price at which they issue the securities, and the fair market value, that delta ends up getting taxed as income from other sources in the hands of the company. So that tax is actually known as angel tax because it primarily applied to Indian residents who are primarily HNIs, your family office, etc., who would come in at their seed stage or your angel stage itself. Non-residents were actually exempt from the application of this provision. As of April 1st, 2023, even non-residents have been included within the ambit. So the only exclusions to that, as of now, are regulated funds, as the private equity venture capital funds that are regulated by the Indian regulator, be it SEBI or IVCA for that matter. And this has sort of become an albatross across the necks of Indian startups because capital receipts are not normally taxed. Income tax is normally taxed as income. It's only the revenue receipts that are actually taxed and subjected to income tax for that matter. So it's a uniquely Indian invention of actually converting capital receipts to revenue and up actually taxing that particular difference. Now, the issue at the core of the issue at the heart of angel tax is the fact that the assessing officers, unfortunately, ask you for your valuation report and all the projections that underpin that particular valuation report and compare that against the actual performance of the company based on your audited financials. Now, anyone who's actually run a startup, invested in a startup, spoken to a founder for that matter, knows that uncertainty is actually inherent in the operating model of a startup itself. They go through numerous pivots. No one actually ends up meeting their numbers. You end up actually going through a large number of changes over there. So the projections are based on a particular point in time, and no one has the ability to actually change those particular projections going forward itself. If you contrast that even with, if you look at any government institution, any sort of listed company for that matter, whatever guidance they give, they always have it within them to end up actually changing that particular guidance. and nobody ends up actually taxing that particular difference. If you look at the listed companies also, numerous companies have actually missed their guidance on many occasions. Now, the consequences of that should only be economic alone, where shareholders, investors decide, I'm not going to give this guy the kind of valuation that they want, end up actually reducing it. Maybe I'll actually ask for slightly more preferential terms, etc. India is the only country where we seek to end up taxing that particular difference. So even if you change even with the recent changes in valuation methods that have come out as of now, even there's a fantastic book written by Ashwath Damodaran, the professor of NYU Stern, when it comes to valuation. He said because these startups are actually very new companies. There's no operating history. They're operating in a state of flux, for that matter. None of the traditional valuation methodologies can end up actually being applied to them. It's as good as guesswork. And we speak to any VC across the world. No one actually relies on an option pricing method, replacement method, discounted cash flow method to end up valuing an early stage startup. Even later stage startups, because the number of pivots and everything they go through, most of these valuations are actually taken not even on comparables for that matter. They end up actually they're taken either on a revenue multiple. They look at the number of customers you end up having, your daily active users, what is your GMV supposed to be, and they end up having industry defined multiples on that. And that's why two companies, even in the same space, started by the same kind of founders who have the same kind of pedigree, end up having different valuations because these valuations are driven by market conditions. So seeking to tax what is effectively someone's future performance to the benefit of hindsight is actually doing a massive disservice to these particular startups. And this is something we've actually spoken to the government about on numerous occasions. Now, the government does have a point of view, which industry also needs to appreciate, saying that they have actually encountered several instances of people actually laundering money by investing at a very high premium, then selling the shares back to the founders at a very, very low price. So the entire money that came in as a capital receipt, for that matter, ends up getting used for whatever kind of purposes that they end up doing. So it was an effective laundering mechanism. But since 2012, when this thing was actually instituted all the way to 2023, there have been numerous changes. You can no longer invest using cash. That's come through normal banking channels. You have to end up reporting this, depending on the kind of investor, either to the Reserve Bank of India, reporting to the Ministry of Corporate Affairs, and you're reporting to the Income Tax Department. You give all the details of that particular investor as well. The tax ID, their address, their contact details, the amount of money they put in. So traceability is actually increased to a large extent. Now, given that we have this much oversight that's actually been built in as of now, why do we actually require this sort of tax to end up actually coming? And what was effectively an anti-abuse measure has unfortunately become a tax harvesting section as of now. So that's actually at the core. And the moment you end up attacking the capital inflows coming into a company and taxing the difference at 25%, it makes it exceptionally hard for any management or any investor to forecast how well that company can actually end up doing. So it's a constant dialogue that's going on as of now. Even the changes in valuation method, unless the government actually prescribes and informs the assessing officer not to just look at this perfunctory comparison of your projections versus your actual performance. If that ends up going away, I believe angel tax is something that can be done and dusted. But until then, there's always a sword of Damocles that dangles over the head of every founder and of every investor as they end up actually going through their journey. It's already hard enough to be an entrepreneur, as you can imagine. These sort of artificial friction that's being injected into the ecosystem, this makes it exceptionally harder for people to end up actually managing and operating.
Yeah, certainly. So I clearly understand you actively advocate against this angel tax phenomenon, right? But at some point, when it comes to, let's say, the different asset classes in the country, especially when we're speaking of alternative asset classes, like you have platforms coming up which include investment in, let's say, films, which include, let's say, investments in any new kind of stuff, REITs for that matter.
Yeah.
Just to protect the security, do you still think taxation is the only way to go about it, or do you think there can be other ways to still ensure security while letting go of taxation?
No, so taxation doesn't become a form of security or defense for that matter. I think that entire thinking is actually fundamentally flawed. You end up at the moment the principle of taxation is simple. The moment you end up having any sort of gains for that matter, any sort of appreciation, then the difference between the cost and the difference between the income you end up getting is what's actually subject to tax. And it's only difference of that, I think, is in case you end up actually having income from salary, there are certain deductions you have for that, but then the gross amount gets taxed. There's always a net amount that ends up getting taxed over there. But I think with regard to different asset classes, one of the most important things that you need to end up appreciating that is these can't end up being unregulated activity. See, I think that's actually crucial. Everyone looks at this as it's fantastic innovation. We should actually do it. There are people who want it. There are people on the buy side who want it, people on the sell side who want it. There are platforms who are actually enabling that. for the same. But what ends up actually lacking over that ends up being regulation. And regulation plays a very, very important part, because something goes wrong and you end up seeking judicial recourse. You go to the regulator. The regulator's hands are tied because these are unregulated activities. So unless it actually conforms to some of the established norms that the regulator has, the regulator is powerless to end up actually acting. If you remember, in India, there were a large number of chit fund scams and everything that happened, where people would actually pool money together into a tontine. They would actually use that for certain purposes. And a large amount of that money has actually been defalcated over time. And it took substantial amount of changes in regulation to end up actually coming there. If you look at the P2P regulation in China also, it's very light touch. But everyone knew how the P2P industry in China ended up actually blowing up catastrophically for that matter. So that's the most important thing to realize in financial services is actually regulated financial services. Regulations play an important point. Even though a number of founders actually balk at regulations, say this is just artificial impediments that are being put in, when things actually go wrong, everyone actually seeks recourse in regulations itself. So when it comes to crowdfunding, when it comes to any of these other alternate asset classes, fractional ownership, and the like, I don't think anyone in the industry or even the regulators are actually against them. The one thing they're concerned about is, look, these sort of activities, if they're actually forming in the market, why don't you actually reach out to the regulator, actually speak to them? In fact, in some of the investments that we've actually made at 314, some of the asset classes didn't have a separate set of regulations that apply. So when we spoke to the founder before we made that investment case, we actually asked them and said, look, this is where you are operating as of now. These are set of regulations that can end up applying. However, given the fact that your business model is actually unique, it is imperative that you go to the regulator and say, look, this is my business. Here's an asset class that's emerging. This is the best-in-class practices that exist across the entire world, for that matter. This is the business model that we operate. These are the guardrails that we've actually put in. This is sort of investor education that we are doing. These are the existing set of regulations that we believe can apply as of now. Please, this is how this industry should be regulated. Let's actually start a dialogue on that and end up actually looking at getting that regulated. So I think that's going to be important. We've actually seen, especially in India, not just India, across the world, most of these unregulated financial services like crypto, etc., are actually facing the music as of now. Because when things actually go wrong and retail investors end up actually losing money, it becomes a political issue. It becomes a regulatory issue. It becomes a social issue for that entire matter itself. So I think putting blinders on and only looking at these asset classes by saying, look, here's a need that needs to be filled, and not looking at how it can be exploited, is actually doing a disservice to the industry, and it's a very myopic view to end up having over there. In fact, even when it comes to crowdfunding for that matter, the securities regulator, SEBI, as well as the Reserve Bank of India, have actually released consultation papers on that. But they said, we understand that these sort of asset classes do actually exist, but here is a way to end up actually making sure that happens through regulated channels. So in case something goes wrong, and a number of cases, there are circumstances where they go wrong because of, I would say execution issues, but then there's also malified actors who are actually there. And regulations end up actually separating the both of them so that business dislocations and business failures and businesses that people taking are actually known to them, versus some of the risks that's happening because of malified actors can be isolated and proper regulatory action can be taken against them in the fullness of time. And we've seen that also. Look at Patreon and some of these guys as well. They've said it very, very clearly. Look, this sort of crowdfunding model, you're not expecting anything in return for that matter.
Right.
And it's because some of the crowdfunding model that people have actually do, which something in terms of regulatory innovation, I've actually seen founders go on social media and say, hey, I'm raising a round of funding. Would you like to invest? And there are numerous investors, and this still happens. They may be sophisticated in their private lives, but they look at that and say, wonderful, this is a fast-growing startup. The Indian startup ecosystem, third largest in the entire world, raised so much amount of money, 111 unicorns, etc. Let me actually put money into that. But they mistake the fact that investing into an unlisted asset is fundamentally different than investing into a listed asset. If you don't like a listed company, you can actually sell it. There's liquidity for the stock. Whereas for an unlisted company, a large amount of the shareholders' agreements are actually driven through the primacy of contract. It's between investors and shareholders, investors and management end up actually putting the kind of contract, and these end up serving institutional investors, larger investors to a much greater extent compared to smaller retail investors, and end up coming there. So if the retail person ends up actually losing money, then they end up actually raising an issue. They go to a regulator, then they end up looking at it and say, look, this is an unlicensed public issue. And across the world, even in the US, you have the blue sky laws, etc. When you do a public issue for that matter, there are certain minimum requirements you need to end up actually meeting, because you're dealing with public money. What two private individuals end up doing without actually making a larger call is actually well within their rights to end up executing. So that's the kind of differentiation we've seen. We've seen in India also as well. We've seen online bond platforms actually end up coming about as of now. The regulator is already speaking about fractional shares and fractional ownership of shares that are actually coming, which has also been some sort of regulatory innovation we've actually seen. When it comes to REITs and inhibits and real estate assets, they've actually created micro real estate assets as of now. So saying, instead of actually running these sort of unlicensed kind of pooling vehicles, here, because people have actually gone and spoken to them, they say, look, we understand there are people who want to meet this asset class, who want a smaller ticket size. Here's a regulated way to end up actually getting that through. And most of these industries only end up growing to a much larger extent when there's regulation and there's confidence. And we need to differentiate between regulation and over-regulation. I think that's a very fine line, because over-regulation is always antithetical to innovation and progress. And innovation always outstrips regulation. And unfortunately, in certain times, not just in India, but across the world, the regulators end up actually over-regulating that particular industry, thereby actually killing any sort of innovation that can come about. So I think dialogue is going to be imperative when it comes to these sort of things. And believe me, when in all my dialogues with the regulator, all my discussions with them, they're the ones who actually ask the industry, saying, look, what are the new models that are actually coming about? What are you guys actually doing? How can we actually end up helping for that? So they're also very proactive in that. The one thing that really annoys the regulators, the moment you end up operating in a blind spot, this entire paradigm of move fast, break things kind of thing that actually predicated most of the innovation that happened in the late 2010s, in the early 2010s and the late 2000s for that matter. I think as of now, people have moved fast, have broken everything. We're now going back to a system of actually just rebuild and reflect. And during this entire time, I think this sort of discipline and keeping these sort of taking a much larger perspective will actually hold founders, investors, and the regulator in very, very good stead for that matter.
Yeah, I think the one reason people dread sort of being in regulated space is because maybe they're afraid that your business itself could be shut down for whatever reason. So the regulators might not be, cooperative enough to let a model like yours thrive. But I think you mentioning that they're open to such dialogue should give a confidence to a lot of people.
No, true. And Krishna, see, one more important thing over there is the moment, put yourself in the regulator's shoes. I think the most abused person in any ecosystem is always a regulator. Where any sort of innovation that happens, they say it happened despite the regulator. Anything bad happens, they say happened because of the regulator. So the view that people have of regulations is actually that. But mind you, when things actually go wrong, for that matter, if you look at the collapse of Silicon Valley Bank and the like, everyone actually waited. The moment the FDIC said that, yes, we're going to step in, people were actually calm. But that's actually because the
confidence and regulation.
The Federal Reserve actually put in those kind of regulations. In the absence of those regulations, what would happen? If you look at crypto, which is still unregulated for that matter, the kind of collapses that have happened, there's been no sort of stopgap mechanism to actually come in. People have lost millions and millions of dollars during that entire piece. So that's the thing. None of these are actually engineering problems or tech problems for that matter. It's always there's a socioeconomic lens that ends up coming to that. And the more you understand this entire piece, the better it will actually end up holding you in time. And if you look at the largest companies in the world, you look at a Google, you look at an Apple, you look at a Microsoft, you look at a Chase, look at a State Bank of India, HDFC Bank, ICICI Bank, any of them for that matter, the larger you become, the more regulated you become, because you become systematically important. And you can't just take a myopic view saying that I'm one actor acting in isolation. It's an entire ecosystem and financial system that exists. And the contagion effect of that is actually huge. And the only person who really appreciates that are the much larger institutions, because they realize that something goes wrong, the entire system ends up collapsing, and the regulator. So when you have that kind of view and that kind of maturity, I think that will actually end up holding a very good stead. If you look at the amount of time that maybe a Tim Cook or Satya Nadella ends up spending, they spend a lot more time in front of Congress than they actually do in front of investors or their board members for that matter. Why? Because they become that systematically important. And any sort of move they end up doing, people always ask them, look, because it has broader public ramifications, you need to end up explaining that. You end up defending those kind of moves over there as well. So I think regulation is the price of success. The larger you become, even if you're in tech or something for that matter, there will be some degree of regulation that ends up applying. So believing that you can end up skirting regulation and doing this sort of regulatory innovation, I think it's exceptionally myopic thinking that will end up being counterproductive to that particular founder and that startup as they end up actually scaling.
Essentially, speaking of taxation, just extrapolating this here, what are your thoughts on, having income tax versus consumption-based tax only?
I don't think this is a dichotomy. I do actually firmly believe from a tax perspective, both of these can actually end up coexisting. If you look at consumption-based taxes that are there, if you look at the income tax across the world, and take India as an example, the percentage of the population that ends up paying income tax in the country is actually exceptionally low. For that matter, because of the thresholds end up being 5 lakh, which is about 500,000 rupees. And anything below that suffers no income tax on the same. A number of people are actually below that particular threshold. 500,000 rupees may not seem a large amount of money, but in India, there actually is for a large number of people who are there. So the income tax ends up actually ends up coming to them. In India, actually, the moment you end up actually exceeding about 3 million rupees, which is about 30 odd lakhs.
Yeah.
Which is about 30 lakhs for that matter. The moment you exceed that, you end up getting taxed at the highest rates, which is about 30%. And then there are surcharges and all this that end up actually applying that. Whereas you look at the US or something for that matter, I think in the slab rates, once you end up getting closer to $1 million or something, is when that rate actually comes in. So there's a much different dichotomy that happens. Whereas you look at the consumption-based tax that ends up there. The consumption-based tax is basically a flat tax. Whether you're a daily wage earner for that matter, whether you're the richest person in the country, it's the same flat tax that ends up actually applying over there. But I think what the important part is from the principle of taxation is to ensure there's a phased approach to taxation that ends up actually coming in. So even in income tax for that matter, because it's actually phased, a similar kind of model needs to end up going a lot deeper in consumption-based taxes. So something that's a staple of a person, like what they need to end up surviving. If you look at your bread, if you look at your normal food, look at your normal vegetables, etc., they should end up actually suffering a lower rate of tax or a small incidental tax. But whereas something that's actually like extravagance or something that's actually purely consumption-led, that can end up having a higher degree of tax. But I think the needless tinkering during this entire space actually becomes counterproductive. You look at an AC, for example, in India, an AC I think is actually taxed at about 28% or something in certain places. Now, AC, if you ask me, given the state of the climate as of now, if you go to North India, if you go to the west of India where there are a lot of deserts, where the temperature can go up to 42%, AC is not a luxury. It's a necessity of. It's impossible for people to actually survive over there without having this sort of stuff. So to tax that at a much higher rate does actually end up becoming counterproductive. So I think there is a kind of dialogue that ends up going over there. I can't think of a single country where there are certain countries, especially the oil-rich countries, that only have certain amount of consumption tax, no personal income tax and the like. But if you notice slowly over time, they're also changing the model. They're slowly actually breeding it into that entire piece. So unless you're actually gifted with large natural resources for that matter, where you don't mind actually giving up this stream of income, I think the government job is to ensure that the taxation actually becomes fair. The moment it becomes onerous, or the moment it becomes complicated, and there are numerous allegations of it being complicated, it being Ramos, it being Byzantine and the like, that's when this sort of tax engineering ends up actually going through as part of that itself. So I think that balance is something that people will end up doing. There is no right answer to this. But unless you can figure out that kind of equilibrium point within, we will always see this sort of dialogue and this sort of, I would say, dissent when it comes to the taxation that comes there.
Yeah, but I mean, the only argument that comes up there is to say that, the first point that you mentioned, a very small fraction of Indians actually end up paying income tax. Yep. So if that's the case, why should a small set of people actually bear the consequences of allow the majority to just enjoy the freedom and consume without having to pay that tax? So that sort of becomes the point of discussion, right? Sure. And it's also true that sure, I agree with in consumption-based taxation, you need to have a phase thing for, let's say, cereals and basic staples. But then isn't all of that sort of taken care of through some kind of BPL benefits?
Not necessarily. The DBT benefits are enough to actually keep body and soul together. And what the government's assumption. It's an average that ends up going over that. There may be certain families where they need to augment that particular piece. Certain families that ends up actually being enough. So for the ones who need to actually augment it for that matter, you know, make sure there is something that ends up, there is some sort of leeway that's actually afforded to them. And even if you look at the thing, even the DBT and everything that happens to people below the poverty line. In case you just actually come across that poverty line, just end up escaping that, you can end up actually getting taxed to a very large extent. Then immediately spiral back down. Then the sort of poverty line becomes a hard glass ceiling that people can't actually break apart. And we've seen this happen in the US and everything also, where there are numerous people who refuse to get off, who can't end up getting off food stamps, who don't want to end up taking higher paying jobs because it becomes harder for them to end up actually surviving. The delta that you have actually becomes extremely onerous on them as you end up going through. And with regard to the taxation part, personally, I would also, there are a number of people who actually say that, yes, there is only a small minority of population who are actually subsidizing, the larger majority that's there. But given the fact in countries like India and all for that matter, where the tax base has to increase, it's a sort of sacrifice that these people are actually making. I think the biggest problem is that if the taxpayer ends up getting harassed by the tax department, they don't end up getting treated with respect. They end up actually seeing more and more. They don't see the kind of benefit to them compared to the rest of society. I think that's when a number of them end up actually getting annoyed. That's when we've seen the number of people leaving the country also. The tax terrorism is one point they end up actually bringing up to a very, very large extent. I think that is something that the government needs to act upon to a large extent and reduce that. Even if there's a very famous quote from the Arthashastra that by Chanakya, which says that the taxation should actually be like a bee actually extracting pollen and honey from a flower. It shouldn't be usurious. It shouldn't be exploitative. It should actually not be the person in a much worse off stance when it comes to that. So I think that kind of dialogue is actually going through. And the expansion of the tax base, given the fact that a large portion of the country is actually in the agricultural sector. The agricultural sector has no income taxes. That's why we see a large chunk of the country not actually paying those kind of taxes itself. So I think bringing them under the ambit, not every single farmer for that matter, but rich farmers above a very large threshold, you will actually start seeing the kind of visibility in the entire tax chain. Because a number of changes we've seen in the tax structure to India. For example, India created a tax collected at source. where in case you send any sort of money overseas for education, for travel, investments, etc., 20% of the money has to be paid out to the government as tax, and you can claim that tax credits against the income tax you end up paying towards the end of the financial year or during the financial year itself. But 20% is way too high an amount. I mean, when people have actually, and there are numerous discussion and debates that have happened with the government, and the government said, look, we've actually seen numerous cases where even though people give their PAN, they don't actually file a tax return. So we don't know how these people are getting that kind of income to have them go overseas. But one of the easiest answers to that is, look, a large amount of the population, because they're in agriculture, and there are several rich farmers in the country also. This perception that Indian farmers are poor, etc., does actually apply to a large majority. But even that significant minority that does exist with much higher purchasing power for that matter, they don't actually end up paying any sort of income taxes over there. So the moment you apply and broaden that net and make sure that visibility comes into the entire tax chain, that's when it makes it easier for the tax department to end up actually getting the right data that they need in order to come out with the practices. 20% is far too high. What is supposed to be effectively having a monitoring system can become a tax harvesting measure, and it becomes onerous. And that's the thing that really ends up annoying citizens to a large extent, because they feel they're not being respected for amount of sacrifice that they make in everything that they do. They're not getting anything in return. There's a sense of frustration that ends up actually coming in, and rightfully so as well.
Right. Okay, maybe I'll switch gears here. One thing that's very promising about India at this point is, let's say, UPI and the success of it. And clearly ONDC is coming up to simplify or at least make life easier for sellers to bring some level of discoverability for them. And maybe through a combination of this, domestic e-commerce is going to boom. But what do you think about cross-border commerce? Because one of the biggest bottlenecks that I still see today is because in any cross-border transaction that you make, you end up losing at least maybe around 6 to 8% to different people, intermediaries.
That's true.
So how do you think that can be tackled?
No, that is actually a fantastic question. And this is something we've also been debating at 314 to a large extent as well, because even with the China plus one and the decoupling and all that's actually happening, I think that it's a fantastic time for India to actually capitalize upon that. But we still have a set of regulations that doesn't actually welcome this sort of cross-border activity, and it ends up favoring much larger players. If you look at it as of now, when you export from India, there are numerous forms you end up actually having to file in triplicate. You can't access payment through a payment gateway. There are a large number of conversion charges that happen. I actually know of exporters who end up paying 9%. So after a certain while, they say, look, is it really worth my time? And they don't get the money immediately. They get it after a much prolonged period of time. So you lose 9%. You end up actually getting the money in 60 days, 90 days, sometimes even 120 days for that matter. The credit period becomes onerous. So for a smaller seller, he says, why do I have to put in this kind of effort, take the kind of risk to end up exporting if it becomes this hard? And a number of these particular things end up filing forms in triplicate, waiting for your refund to end up actually coming in. The entire transaction chain is actually still broken as of now. That's why I think even the fact that it's actually broken for that matter does actually prevent India from making the kind of exports that it does. If you look at if you look at your Reliance and others who end up actually exporting oil and end up actually exporting petroleum products, they have the kind of infrastructure and the kind of machinery inbuilt to them to handle these kind of compliances and enforces and everything that's actually similar. But if it's two guys and a laptop actually sitting here who end up having a SaaS product, if you have to fill forms in triplicate for every single SaaS subscription that you have, you'll die. It's impossible to end up actually managing. And the lack of a payment gateway integration that comes in over there, the lack of automation of some of these elements, the fact that it's reliant on physical forms is actually counterproductive to the entire idea of digital India. And this is something that we as an industry have actually taken it up with the government. We say, look, these are the kind of friction that does exist. These are the kind of changes that we need. They've already started dialogue as of now. Some changes have happened. It'll be a long way to end up doing that. But I think what's going to be important over here, Krishnan, is the fact that these actually end up becoming opportunities for startups to end up actually creating products over there. We've actually invested in a company called Zindis, which actually does cross-border logistics. Even the aggregation for logistics itself, you go to a DHL, you go to any of them for that matter, the cost ends up becoming so high, it eats into your margins. The payment gateway costs also become exceptionally high. So the person's actually innovated in some of these areas for that matter, innovated within the regulatory regime, of course, working with the banks, working with these kind of providers, aggregating it, giving sort of fulfillment. Because you get cross-border trade. At the end of the day, it actually boils down to trust. China has done a tremendous amount of work over the past 20 years to make sure that there is actually comfort that's actually given. If we say the goods are going to be delivered by so-and-so time, these are payment methods, this is how we'll end up receiving it. They have comfort with that. And for the person who's end up decoupling from China as of now, they have to restart all of this from scratch. So finding those kind of people, do they believe they have these kind of capabilities? Can I actually make these kind of payments on time? Will I actually receive the goods on time? Will it be of the kind of quality they want? Will I have to return it for that matter? What is the way I end up actually doing it? These are all problems I believe that startups can end up actually solving. There is a regulatory change that's actually required. I don't think anyone's actually disputing that. But we need to accelerate that kind of regulatory change so that India can actually end up achieving its potential. And I do believe with the internationalization of UPI as well, some of these issues can end up getting solved through tech. But these minor operational friction, it's actually inherent in the entire system, actually ends up eating away to them. It's already hard enough to be competitive globally with other countries where these sort of capital controls don't exist. Easy for them to end up receiving money in various currencies, etc. So to put Indians on this sort of lower footing and then end up hammering them even more through regulation, does a fundamental disservice to these kind of business itself. So hopefully there is a sea of change. There is actually appetite from the regulator to end up solving this. There are already startups and there are already industry participants engaging with them. So we are actually hopeful that in the fullness of time, maybe not in the fullness of time rather, that's actually far too long, but in the near future itself, we end up seeing the kind of changes that we need to enable this sort of thing to happen. Because exports, at the end of the day, exports actually gets valuable foreign exchange, ends up actually driving an economy to a very large extent. China actually built its entire economy on the back of exports, for that matter. We've seen Vietnam, we've seen Laos, we've seen all these countries end up actually building it on that itself. So it's important that India has consumption to a large extent, but exports are also has to start playing a larger, more outsized role in order for the balance to actually come into the economy.
And you're optimistic about regulatory support in this entire regime?
There is. See, the one thing this is the one thing I end up having. This is one problem I end up having with entrepreneurs to a large extent. Everyone believes that their means of engaging the regulators to actually go on X or Twitter X, whatever they call it, go on Google, go on social media, tag the regulator and just give some sort of rant over there. That's not the way you're engaging. No one actually changed the regulation because someone was cranky on social media and actually said something there, right? They ask for data. They ask for comparisons, they ask for proper means of engagement. And mind you, I've never seen a situation where the regulators actually chase someone away that actually come. But the problem is, a large section of the entrepreneur base genuinely has this sort of allergic reaction to regulations and the regulator, for that matter. So when the regulator doesn't get all the information about what's happening in the industry, these regulations end up actually creating isolation. And some of these regulations that were actually written way back in 1999 and everything for that matter, didn't actually conceive of the digital era that we're living in as of now. Even the privacy laws, etc., from 2000 have actually been updated in the year 2023. So unless industry actually engages and a broader section of the startup industry ends up actually engaging with them, we're not going to see that kind of change happen. Because ultimately, unless you actually go there and lobby, unless you actually go there and inform them, tell them that this is the kind of friction that we have, these are how the regulation change. And this is how we can make the changes without bad actors actually exploiting it. There's a lot more comfort that actually comes in from there. Because the one thing they look at, like I said, is it may be great that there are certain tech companies who end up actually walking the straight and narrow. But what about the other malified actors who end up actually exploiting the system? How do you protect against that? And you can't say that's your regulator's problem, not my problem. Then it's easier for them not to act because they think in decades. What happens within few months of a year doesn't actually make a world of impact. They don't mind sitting and waiting on it, observing how it changes, and then deciding to end up actually acting on that. Because the moment the regulator reacts, I think there are shockwaves across the ecosystem. So a model of engagement is that, mind you, in the US, we've actually seen this happen in the US, in Europe, etc., where even startup founders end up actually engaging the regulators very, very early on. And their culture is yet to end up actually coming to India. Where I think that's actually a signal of maturity. When you see these sort of things, these sort of conversations happen, the founders even talk about this and choose to engage, that's when we'll actually start accelerating to a much larger extent.
Within the same context, addressing the recent import ban on laptops, for that matter, do you think, of course, it's a great initiative to sort of promote making in India and stuff, but at the end of the day, don't you think this is just going to be beneficial to the largest players who already have the kind of capital and resources for them to just come and dominate the Indian market as well? Let's say Reliance, for that matter, can just introduce, a laptop, and they'll already have the kind of resources and capital to sort of flood the market with their laptops, maybe at discounted prices to grab market share. But at the end of the day, it directly kills any upcoming competition or this whole objective of Make in India, where you have at least, smaller players trying to spring up and come up with some kind of innovation. Don't you think it does that?
So that's actually true. So the way the ban actually came about actually surprised the entire industry. And I think they also rolled it back, they postponed it, started doing a large number of things. But if you look at the history of that particular ban as of now, the Indian government has something known as a production-linked incentive scheme, the PLI scheme that's actually there. And during the course of this particular PLI scheme as well, what they've actually said is, they said, look, we want this sort of manufacturing to end up happening in India because India is actually spending a significant amount of its foreign exchange to actually import these particular components. And they've already had this PLI scheme for hardware. There wasn't much of an uptake because people just said, look, China's already so close by. The shipping lanes are already done. We can just import it for that matter and actually make it easier. So I think it's more or less a carrot and a stick approach. The PLI scheme was actually the carrot. But the moment they realized that people were actually nibbling at the carrot, that's when the stick actually came in. And mind you, if you look at the largest laptop companies in the world, be it your Apple, be it your HP, be it your Dell, be it anyone else for that matter, everyone actually does contract manufacturing. Very few of them end up having factories by themselves. So the contract manufacturing base, in order for them to get that kind of carrot to actually come through, that's when this particular thing happened. And mind you, there are already the fact that Apple started assembling in India. They're already starting to increase the manufacturing that they do as well. So the value addition ends up increasing, as opposed to just importing from China, slapping on a sticker, slapping on a few screens, etc. Components, end up actually shipping that through. So is it the right way of doing it? I don't think it's a morality question of right or wrong. Could have actually done it in a better way. I think that's actually true. Greater dialogue, giving some sort of sense of that, because the way it happened in isolation and it coincided with the launch, with certain launch, etc., people started extrapolating a whole bunch of wild things. Isolated incidents started getting mashed together, and people actually started making sort of wild claims over that. So I think this sort of shock and awe level of regulation is something we need to actually get away from to a large extent. Give industry time to end up actually absorbing it, have a discussion and a dialogue with them. Make sure that when these changes happen, there's already a strong foundational base that can end up actually building upon this. Because the gap that ends up actually existing over there actually does a tremendous disservice to the entire country, which it does. So I think those sort of schemes as of now, it could have actually been done better. I think the government they've actually pushed it, advanced it. They've actually started holding dialogues with various people now, having that kind of conversation. Some of this should have actually happened before the announcement was actually made. Such that the initial headlines that dominate, still end up dominating conversation as of now, rather than what I just spoke about and the context that actually goes in behind that itself.
Got it. And one thing you mentioned that caught my attention was this internationalization of UPI. So in that scenario, sort of, do you think the world will move from US being a reserve currency to some USD becoming a reserve currency to something else? And if not, do you still see the point of different countries having different currencies and this entire forex business?
Yeah. So that's actually a fundamental macro question. In fact, I think even during the Bretton Woods conference as well, John Maynard Keynes actually spoke about the fact that we need to have a common currency known as Bangkok, which is a bank currency for that matter. So the bank currency can actually be, its value can actually be derived from a basket of currencies consisting of the US dollar, the Japanese yen, this, that, and all the British pound. Sorry, not the Japanese yen, but the British pound and whichever currency was actually there in Europe for that matter. But I think what happened at that point in time was, since the US was the only one that was actually unscathed by the entire war to a large extent, the entire whole of Europe was actually wiped out. India was still under colonial rule for that matter. China was also actually going through a large amount of tumult, and the same. The US actually became the only country with the kind of consumption base and the purchasing power that could actually end up putting it out. And given the fact that the Marshall Plan actually became the norm, then a large amount of reconstruction that happened across Europe was actually fundamentally contingent on the US dollar. And given the fact that the US actually managed to negotiate with the Middle East during the 50s and the 60s when it came to oil purchases as well, because energy is a fundamental input no matter what you do, whether you're in tech, whether you're in AI, whether you're in farming, whether you're in services, anything for that matter. Energy plays a very outsized role as a fundamental input. The fact that those are actually denominated in dollars did actually give the US this sort of fundamental privilege across it, this sort of exorbitant privilege, as one of the European central bankers put it, across the rest of the world itself. So even with the decoupling that we've seen as of now, and if you notice during COVID as well, the US, I think during a day, ended up creating India's entire GDP as stimulus. They've actually given their citizens checks for that matter, whereas the rest of the world couldn't actually end up doing that. That's why the inflation in the US is not as high as the inflation as you see across the world, because there's still great demand for the US dollar that ends up coming over there. But see, if you look at it from a fundamental basis, if the US is the largest consumer in the world, the US would prefer to actually pay in its local currency. Unless we actually see other countries end up actually having that level of consumption, and not exports for that matter, but the level of consumption, it's going to be very hard to end up actually replacing the US dollar to a large extent. So will it go away as a reserve currency? I think in the fullness of time, we'll actually start seeing a multipolar world as opposed to unipolar world for that matter. So not going to be the US currency alone, but if India becomes large enough, India can already settle its trade in INR. We're already doing that as of now with certain countries. China as well, if you've actually seen, is actually giving out loans in renminbi. And they're actually giving out renminbi, they're settling in renminbi, they're actually purchasing oil in renminbi for that matter. Because see, a large amount of the role of currency is also in the settlement of trade. If two countries are actually trading and they have their own currency, they decide to settle in their own currency, they should be allowed to actually end up doing so. I think that actually becomes a fundamental difference. So that sort of changes that we end up seeing in the global macro situation. Will we see one global currency for the world? Unless there's uniformity in terms of purchasing power, uniformity in terms of economic and monetary policies, no. But we'll see multiple currencies becoming the norm as of now. I think the answer is already playing out as we speak and only get more pronounced as we go ahead.
Yeah. So, addressing the point of US again, right? The moment you say that it's the largest consumption or consuming economy in the world, it's largely driven by, also we need to remember that it's driven by debt. And the very fact that they can issue as much debt is because of some certain privileges that they have that most other countries do not. So how is it even fair to say that, okay, they are the largest consumer because you're not giving others the option to become largest consumers?
No, they have that. See, if you look at the debt of the US also, right, the reason the US has so much debt is because of the amount of consumption that they look at the export-driven economy of China for that matter. Despite all the friction between China and the US, China thing was actually until recently when Japan overtook them, one of the largest holders of US Treasury bonds for that matter. Because see, ultimately, when you're sitting on large piles of cash, everyone wants certainty, everyone wants safety. It's no longer the incremental return you get on top of that. It's about ensuring principal protection. I look at it from a world perspective also. The US government is still, despite everything that's actually going on there, still has an immense amount of trust the world has immense amount of trust reposed in the US government and its ability to actually service any debt obligations that it has. Mind you, it is possible for China to end up actually raising bonds and actually getting that kind of part. But there's a large degree of trust that happens. And the US currency also is actually free float. It has almost complete global acceptance. It has free currency convertibility. But if you look at India, there are capital restrictions that exist as of now. You look at China as well, there are still capital restrictions that actually exist. The moment you have these sort of restrictions, and the ability for a single player to actually say, look, I can actually end up changing the particular currency conversion rate. I can end up actually putting restriction ability to take money out. It does actually increase the amount of risk associated with that. Because the US is actually free float for that matter, it does actually give them that sort of ability to end up absorbing that money. And mind you, the US also ends up actually taking on a large amount of debt because of the large amount of exports the rest of the world has. Otherwise, the world doesn't have enough investing avenues to end up actually putting that kind of cash. So if you look at accounting, that's why I actually love accounting for that matter. The balance ends up coming in. One man's assets and there's another person's liabilities and vice versa itself. So look at the government or US also. The reason why they put that kind of debt is because the market ends up accepting it. The day we end up seeing the market end up reducing its uptake of US Treasury bonds for that matter, that I think is going to be the day in which these sort of conversations become a lot more important for that matter. But the question that will arise then is who's going to take their place? If you look at the global reserve currency, look at how it was actually the Portuguese currency in the early 1500s. It was the Spanish, then it was French for a little while. It became the UK for a long time. Then it became the US. Now the question is, next person is going to be who? Who's going to have that sort of GDP heft to end up actually absorbing the amount of demand that's actually coming in over there? Who can actually service that level of investor appetite? Who can end up actually consuming to that extent? The thing is the US as of now, they're still the largest economy in the entire world. And China is also there, but those capital restrictions end up actually casting a pall on the ability to end up actually doing this. And China, I don't think, has given any sort of indication to end up changing its stance on that. India also, I believe there's a Atharapo report or something, I think in the early 2000s, late 1990s, we said we should actually end up moving to free currency convertibility. It's been more than 20 years as of now. We haven't actually made those strides. I think only recently we got included in the JP Morgan emerging index bond, emerging bond index itself, for that matter. So I think these are kind of changes that end up happening there. So the moment you have a more freer economy, the moment you have this sort of easy flow of cash for that matter, the more attractive you actually become from an economic perspective. So it's not just GDP, it's consumption, it's a trust that people actually face in the government for that matter, and the ability to end up absorbing these large capital flows coming in. I think those are the fundamental constituents that if any country ends up meeting that, there's a good chance it can end up actually becoming the global currency going forward.
Speaking of this in the Indian context, I've had Sharat Sharma, an expert in my podcast before, and then previously Dr. KV Subramanian, the previous chief economic advisor of India. One thing that we spoke about is how India starves with access to credit. Less than 1 in 6 people have access to credit. And Sharath had a point of view that whatever credit we have in the country is largely consumption credit, and there's very little business credit available in the country. And sure, OCAN is one framework which is supposed to enable credit. But then how will credit even come into access or come into supply. How do you think we can improve access to credit for Indians?
Yeah. See,
both on the business front and the consumption front.
True. I think, one of the biggest things you've actually seen from a credit perspective in India, especially to businesses, is actually a large amount of it is asset-based financing. So unless you have a very large captive asset base for that matter that you could end up actually hypothecating or securing against the lending that you do, your ability to access large pools of capital is actually very, very limited. Large pools of debt capital is actually very limited for that matter. But you look at it, a number of businesses, especially smaller businesses, don't need very, very large loans. They don't have assets for that matter, but they do actually have cash flow. They do end up actually transacting, doing business. That's why the informal network still exists to some extent. Because if you look at a vegetable vendor for that matter, they may only end up needing, let's say, 1,000 rupees or 1,000 or 5,000 rupees to end up actually going to the market in the morning, 4:30 in the morning, procuring goods. And they're confident of being able to sell that 5,000 rupees and actually paying that money back by the end of the day. But what access to credit do they have? If they go to a bank, it's too small a ticket size for the bank to end up actually underwriting. And the bank can't end up spending that kind of time to end up looking at this person's cash flow history to decide whether they're worth lending to or not. There's certain size you need to end up actually doing. And that's also because the restrictions that apply from banking as well. That's why the NBFCs and the like have actually stepped into the entire piece as well. So you look at you look at all these kind of things. The friction to credit still actually does exist. We have the tech rails, mind you, for that matter, to end up actually making the kind of decisions. But the regulations also need to change to give greater credence to cash flow-based lending. We are yet to end up actually seeing cash flow-based lending and the underwriting that's associated with that. Despite the ability for you to actually disperse a loan to that person's account, make sure they collect everything to UPI, you end up having first charge, whatever money comes out to end up actually clearing your loan out. We're seeing the regulations are yet to end up catching up to this particular extent. So OCEN's a great step forward in that regard, in terms of actually creating these kind of formal channels, increasing the access to credit that people end up actually having. But I think that's been one of the fundamental barriers we've actually seen. The second thing we've also seen, especially from a number of startup perspective, etc., is, and this is also based on asset-based lending, is the moment you're not profitable as a business for whatever reason, your access to credit immediately actually goes away to a large extent. Because what they don't end up seeing, what most of these companies, what mostly banks and financial institutions don't actually see is the concern they have is that if you're not actually profitable, where are you generating internal accruals to actually repay back the principal? And they can't rely on external injections of capital for that matter to end up actually taking that kind of recourse. That's why we've seen venture debt and NBFCs actually start dominating the space in terms of startup debt financing, compared to banks and your more traditional financial institutions for that extent itself. So I think it's also a question of the sort of, comfort that the banking institutions end up actually having. And even though we've seen asset-based financing actually be there, even though we have the IBC, the Insolvency and Bankruptcy Code, we've actually seen that even just because you have assets or very large assets that are hypothecated, you're unable to actually liquidate those assets at that current carrying price. Or even if you have to end up running the asset, India is yet to develop that degree of operational depth to actually get professional managers to come in, take over the particular asset, end up actually running it. So even though it's fantastic comfort for them, that comfort is actually primarily driven by regulation. Even the banking regulation as of now, above a certain amount, you give a personal guarantee. Even some of the guys who have actually gone to the bankruptcy code and they're actually living very, very grand lives, so given personal guarantees, no one's been able to enforce that. So it's just a paper tiger that actually exists over there. And that's preventing a larger number of companies, even good companies for that matter, or good small businesses, from accessing this sort of credit. We're already seeing startups make tremendous strides over here through the NBFC framework to start giving access to these kind of things as of now. But because the cost of capital that they have is still so high, and because the banks ultimately are the source of capital for all of them, and banks look at this kind of operating framework and say, look, it's too risky, I need to give it a higher risk weightage because of the RBI risk weightage that I end up putting in place. It drives up the cost of capital and ultimately drives up the cost of business for them. And unless we lower the cost of capital for these kind of businesses and reduce the kind of friction, it's going to be very hard for these companies to end up actually scaling. And India has always seen a small amount of debt. You look at the startup industry also as of now, as an example, is raised far more equity than it ever has actually raised debt. And we've actually seen companies raise equity for working capital purposes. These are companies with strong cash flows, large turnovers of inventory, very stable businesses. But just the amount of friction it takes to help them access credit is huge. Even when we've helped our portfolio companies, we sat with banks, work with them through the credit underwriting model, have them understand the business a lot better, point to it and say, look, even though the company may end up actually having some degree of losses as of now, these are the investors who are backing it. They don't mind actually funding these particular losses over time. These are the model's margins that are actually improving. Year on year, here's how it's actually there. It becomes a prime candidate for that. And because we spend this kind of time with them, with the banks, with the companies, we've actually been very successful, happy our companies end up actually raising credit from banking institutions also. So unless a level of effort comes in a few select champions end up going and actually working with these financial institutions, help them understand it, we're not going to see that kind of change. You can't end up writing white papers and blogs, etc., speaking on panels and hoping that ends up actually changing it. You genuinely have to roll up your sleeves, end up engaging with them, understanding their problems, their issues, helping them develop these new sort of credit underwriting models. And then you end up seeing the kind of change you end up happening over that. So I think right about now, even the early success that we're seeing is actually enthusing these banks to end up taking these sort of paths. And credit on UPI, linking a UPI to a credit card or something for that matter does actually make a fundamental difference. And if you looked at it, what Aadhaar has actually done for individuals as of now, the government's actually announced that the PAN or the income tax ID will actually serve as the Aadhaar for businesses. So the moment you reduce that KYC time for businesses, and mind you, as a business, you ever applied for a loan, if you applied on a personal loan, there are numerous offers, numerous calls you get. You click on one button, the money comes to your account, everything is already sorted. But for a business, there are so many reams and reams of paper you have to put in. You have to do this KYC, sign this in blue ink, not in black ink, because if it's black ink, it could be Xerox. All this kind of crazy rubbish is actually inherent in the system. Yeah. When we were opening a bank account once, we actually signed in a black pen because there was a pen available. The bank guy said, no, you can't sign it in a black pen, it has to be blue. I asked him why. He said, how do we know it's original? I said, I've literally signed it in front of you, man. What more proof do you need that it's original? He said, no, black ink means Xerox, signed it in blue. So this is the kind of really stupid stuff that ends up actually preventing that. So having this sort of Aadhaar moment for business as well will reduce this amount of friction. And the moment the cost of actually customer access or even dispersing a loan reduces, it actually enthuses banks and financial institutions to make these kind of credit decisions a lot more simpler. And many of them are looking to templatize a large amount of this itself. Some of the fintech companies we invested in are actually working with these banks and financial institutions to create this sort of program, saying, look, if it meets these sort of preset parameters, allow us to work with you through our MBFC to end up actually giving them credit. And then as you graduate, as you get a credit history, it becomes easier. See, the hardest part is, even look at the US where you are as well, especially for any sort of student that's actually gone there, getting a credit card is exceptionally hard. Because look at that, they say you don't have a credit history, how can I actually give you a credit card? But unless you have a credit card, you can't have a credit history. So it becomes a sort of chicken and egg kind of situation. And that's not just in the US, but that's across the entire world. Even India has the same problem. So I think tech is actually solving that. Startups looking to make inroads into that. There are several banks also who are actually taking that kind of leap as they end up actually going forward. So I think that will end up actually holding us in good stead. There have been massive dislocations over the past few years because of COVID, this, that, etc. So it's actually paused some of these projects. But I think right about now, we are actually seeing that flywheel start. And we are seeing a lot of people end up actually venturing forward in these areas.
But don't you think we already have enough tech rails as well as models for underwriting, for tracing, how the transactions are happening, how things are moving forward? Maybe Europe is one of the initiatives on that front as well. So do you think it's largely a regulatory sort of impediment that's preventing banks from sort of supporting such kind of credit, which is asset-based financing? Or do you think we still lack something on tech front?
No, I think the tech part, that's one thing about India. We end up actually solving the tech part far quicker than we end up solving the regulatory part. But we spoke to Siddarth and all that. I said, we built all this 5, 6, 7, 8 years ago. We're still waiting. But that's the thing, right? In regulated financial services, because there's so much legacy baggage inherent in the system, it takes a substantial period of time for people to end up getting comfortable with these kind of new models. Because if something goes wrong within this, there are obviously heads that are going to roll. And there is always a risk that some of these, it's the same as any sort of credit portfolio that you have. A chunk of the credit portfolio won't end up actually paying that. That'll end up driving the cost of capital. But a good chunk of them ends up actually doing it for the same. And because the new credit underwriting model, they look at it, they say, do I have to spend this much time and effort for something that's actually small in ticket size? Or can I place an equal amount of time and effort to end up actually giving much larger loans for that matter? The State Bank of India chief actually said we have about 1 lakh crores, a very large, substantial amount of money in that we want to end up actually lending, but we don't find quality borrowers to end up doing that. Whereas you speak to anyone else, they say, look, there's a large chunk of the MSME market that can end up actually using this kind of credit to end up coming through. So regulations do actually play a role in that. We need the banks to have a lot more latitude to make this kind of lending over there. Even though we have MSME lending and these kind of things, they ask for a credit guarantee. They say, if we don't have assets to end up actually guaranteeing that, how do we end up actually doing it? They ask for a personal guarantee for the matter. And they look at it. If the person actually had the kind of assets, a large house or something that he could hypothecate, he could actually get a personal loan and put it into his business. But if you're asset light, if you're a business which is asset light, you don't have a large net worth, you can't give these sort of guarantees. What is the kind of credit you can access? The answer is not much. Even though the government has come up with a credit guarantee scheme for MSMEs and startups, etc., it is actually the cost of capital that was 14.5%, 15%. It's exceptionally high. The founders of these businesses can actually get a personal loan at about 11.5%, 12%, end up actually doing that. And that's a substantial difference mind you, for these kind of businesses which have very razor thin margins. So it is regulation. The tech is already solved to a large extent. I think the regulation has to change, and the banks also have to get a lot more comfortable. So running these sort of pilots and everything over there becomes important. That's where NBFCs and startups play a very important role, because they can create these sort of portfolios. They can take that kind of risk because they end up raising risk capital for that matter. Then they end up raising debt capital to end up actually expanding their book. And they end up actually scaling these sort of programs over time. But what may seem large to a startup, like a $5 million book or a $10 million book, is exceptionally small to a bank which has $1 billion, $2 billion, $3 billion, $4 billion book. They look at that and say, why should you end up putting that? So I think the economies of scale is something we're yet to end up seeing open up to a large extent. India has also been very, very guarded in terms of debt. There are far more regulations on debt than actually end up applying to equity for that matter. So I think that's the reason. And one of the reasons why debt has such a large overhang is because a large amount of the banks all the banks end up actually asking public funds. So they have to be a lot more guarded. India is still traditionally very, very risk averse. And RBI is among the most conservative regulators across the entire world. So it takes a much higher burden of proof to convince them of this. But despite that, we have the RBI Innovation Hub and several others looking to end up actually putting a lot more of this forward. And if you look at some of the comfort in terms of invoice-based financing, etc., some of these things, when you speak to the banks, and I did actually speak to a few banks about that recently as well, they said they've actually noticed instances of fraud happening over there, but there are false invoices that end up actually coming in. People try. So weeding out this kind of bad actors. See, us in the white economy or in the more regulated economy don't end up actually, we can't even think of the kind of fraud that some people end up actually perpetrating. But people sitting in the banks whose entire job is actually risk management end up seeing those kind of things and say, look, even though if I make these sort of concessions here, you may actually do well, but that's great. But then a number of other people end up actually exploiting these particular changes. So that balance, I think that balance and that dialogue actually becomes important. And we've seen these kind of changes happen now. We've actually seen a number of NBFCs lending to startups, smaller businesses, end up actually growing their book, end up becoming much larger for that matter. So, and they're also working with banks to end up actually reducing their cost of capital. I think that sort of thing is already going through. And the moment we see a few of them end up actually going through the entire rigors of a listing process, speaking to analysts, seeing the fundamentals of the business model, that will actually enthuse a larger number of financial institutions to make these kind of things. Because the long tail, the profits will always remain in the long tail for that matter. And the long tail is actually exceptionally large for that. Unless we start servicing the long tail, it's going to be this sort of very unequal growth that will end up coming in, which will actually end up becoming a fundamental issue from a macro perspective.
And one more thing you mentioned about all the electronic signatures and the arduous KYC process. I mean, personal experience, when I was incorporating my company 6 months ago, I had the 45-day waiting period. Whereas, let's say if I were to incorporate my company in the US, it takes 2 to 2.5 working days. How do you think we can reduce this, duration of setting up businesses, going through regulatory processes in India?
So there's something. So I work on something known as the Stay in India checklist. It's an initiative created by industry. It's actually championed by iSpirit. It actually works now with several other organizations, etc., to actually go to government and say, look, these are the reasons why Indian founders choose to incorporate overseas and choose to actually start their business overseas as opposed to India. And the time taken to incorporate is actually one of them. So even though the government has this sort of SPICE form for them, they've actually created an integrated form that helps you get your tax ID, all your tax IDs, help you open a bank account, help you get registered with DPIT as a bona fide startup, incorporate a company, etc. What we actually see, there are certain friction elements within the form. For example, if you look at the name, and for some reason I still can't figure out why, in numerous cases, the name ends up actually getting rejected. Which is so crazy, right? If I choose to call my business XYZ for that matter, whatever random name I choose, why do I have to justify the name to someone else? So long as it doesn't impinge on a trademark on the same, so long as it's not, I would say, vulgar, which is, it's something that happened. I remember there was a very famous band in the US or something whose incorporated entity was some poopy butthole LLC or something like that. It was a rock band, I think, in the 80s and 90s, because they'd all be great fun for their accountant and lawyer to actually answer the phone call and say, hi, I'm speaking on behalf of Poopy Butthole LLC or something like that. We can't have that kind of stuff in India for that. Now, the question is why? Even if you, obviously, if the name is not vulgar, they should be allowed to do it. But why is there someone sitting at the back and trying to actually moral police the person's name? So this sort of friction actually comes in. Even look at the registered address for that matter. We actually give the lat long of the registered address because the government actually found that there were numerous people running shell companies and actually doing that kind of thing. But the lat long part, if you incorporate in a co-working space, becomes tougher. So what we've seen is the tension between, I would say, some of these bad actors and good actors is why the good actors end up actually facing the kind of friction. The government has actually taken steps to end up actually making this form better. And there's still an open dialogue. They're still actually tinkering with this. They still have to make it easier. They're like, in fact, even the corporate registry system, the MCA website was actually down for a substantial period of time. That may have also contributed to why it ended up taking that long. I think it's actually, it's functional as of now. They've actually made that thing a lot better. But this is something they're actually working on. So I think, see, the tension between this sort of legacy issues and those bad actors versus the new economy that's coming in, India is still in that transition phase as we speak. So these are things that are important to government, important to industry, something we're actually working on. And we have made tremendous strides. I think it's just a large 10-15%, which just a trust deficit in India actually end up bridging. I think that actually ends up becoming important over there. But I do agree that these are the thing about, you don't actually need grand changes to the tax code or anything for that. It's just operational friction. The harder it is for you to do basic stuff. It's already hard enough to be an entrepreneur, hard enough to be a founder. If you have to have this artificial friction that's actually injected, it just puts a large number of people off. That's why initiatives like this and this kind of dialogue that we have does actually end up making some amount of difference.
Do you think entrepreneurs have some, room here to sort of enter into this whole game and make operational efforts easier?
100%. If you look at the visa, if you look at even applying for a visa, India's passport is still not as strong as the rest of the world. We've actually seen startups come up in that space that actually help you expedite the process of applying for a visa. Similarly, when it comes to incorporation as well, I'm fairly certain that the moment these companies can end up accessing the MCA and having those kind of API calls available, I'm fairly certain they should be able to end up actually solving a number of these issues. So it's once again an area that's actually ripe for disruption. And there are already companies actually working in these particular areas.
But do you think, let's say, folks like MCA or the income tax department would be comfortable making, integrations with?
No, they should be, because I think from their part is they actually require industry to actually come up and say, look, these are the kind of standards that you need to have from your API call perspective. This is how the information flow happens. Because as far as they're concerned, right, whether they get the information from X, get information Y, get information Z, information only collates with them. So long as security is actually taken care of and there's no additional friction that they will end up encountering, or there's no sacrifice on the kind of information requests that they have, they are actually conducive to happen these things. But because you're working with government and has to end up doing these massive changes, it does happen. There's actually an initiative from iSpirit, working with Meti and others, known as actually zero friction enterprises. How do we end up creating these kind of API calls and standard calls for people to end up actually going through? So those conversations are going through. We have to actually move to a pilot stage to end up actually solving that. But I think the moment we have more industry participation when it comes in here, you end up making that kind of change. See, that's the thing, right? For a country as large as ours, if one or two people face that issue, is not large enough to end up actually causing concern. You need hundreds and hundreds of people who are actually willing to put forward, say this kind of thing, end up actually engaging with that. That's when you actually see these kind of changes. And mind you, these are KPIs for the government. The time taken to incorporate, all the discussions I've had with MCA and others, they're very sensitive about that particular topic. So the moment you bring that up, they say, what are the issues you're facing? Bring it over to us. They try to solve some of these issues. But when they solve it in isolation and they don't involve industry during the entire process, that's when the friction starts coming in. Because what they may perceive as not being a problem is a fundamental blocker from the industry's perspective. And what the industry believes is something that's benign may end up being a fundamental blocker from their perspective itself. So that balance and dialogue, that keeps you asking about, that balance and dialogue is important. We can't run, we're too large an economy as of now to end up actually running all this in isolation, for that matter.
Okay. One more point that you brought up is this whole thing that a lot of venture capital in India is equity driven and not debt driven. Do you think it's a good idea for startups, especially the ones which are typically venture backed, which are mostly on the high growth front and not necessarily with enough cash flow or even revenue for that matter? Do you think it makes sense for venture backed firms to deal with debt instead of equity?
I think it's debt actually forms a very important part of the entire capital mix of a company. The moment you end up raising equity for working capital purposes, it's dilutive. It's an extremely high cost to end up actually paying for something, and you're actually replacing debt, which has a particular role, with equity, which is counterproductive to the entire cap table, to the entire business itself, for that matter. But I think, the important part from a debt perspective, because we're not as large a debt market as maybe the US or some of the other countries, for that matter, on the same. There's a certain perception of the role that debt actually ends up actually playing. So I think if it's a high growth, high burn company, which may also end up being unsustainable in terms of its operating cash flows, that makes it a very bad candidate for debt. But if you look at the best candidates for debts who are there, even though the company may actually have, the company should actually, number one, actually have strong cash flows coming in and predictable cash flows for that matter. So if it's a D2C brand where there's no predictability that happens, the revenue one month goes up 100%, 2 months later ends up dropping 80%. it's very hard for the bank to end up establishing a baseline or the credit organization to establish a baseline as to what the baseline revenue actually is. So the quality of revenue actually becomes an important part. There has to be a level of stability. There can, of course, be vagaries within that and variations are the same, but the variations shouldn't be that extreme for that matter. So I think that's actually one important piece to do. The second important piece is that the role of debt over here should actually be to service the revenue that's actually coming in. What we've seen, what banks have also told me at a certain point in time, that some entrepreneurs end up actually looking at debt as a substitution to equity. So if I'm going to have I'm going to hire a large engineering team, I'm going to actually spend a large amount of money on marketing for that matter, or even expansion without corresponding change in revenue. They want debt to end up doing that kind of role. Debt can't replace the risk that equity actually ends up taking. When a business reaches a slightly more steady state, that's the role that debt actually ends up actually playing over there. So I think understanding the debt piece becomes important because some of these startups end up only accessing debt when they think, okay, I have about 10 million revenue, 20 million, 30 million revenue. That's when I can start accessing debt. Whereas the banks also say, look, even if you have like $500,000 or $1 million of revenue for that matter, and they're somewhat steady, we would love to end up actually engaging with you. And from their perspective, and the debt perspective, this is important. Your equity track record, your track record of raising equity does not give you an inordinate advantage when it comes to raising debt. You have to end up starting from ground zero. So it doesn't matter if you're a $100 million business or something for that matter. When a debt guy actually looks at you, he's not concerned about what your future growth is. If you may grow 100x, his return is going to be the same interest rate that he's going to actually end up giving you. So he can't take the kind of risk. So how do you de-risk the kind of business and put that? So that's why the operating margins of the company become important. Because if you're losing money on every single order on the same, then the debt guy is going to feel scared saying that, look, where is the repayment of principal going to happen? Because equity investors take that risk. If one or two companies in an equity, if a venture capital fund actually go down to zero, that's a risk that's actually inherent and baked into the model. Whereas for debt, they can't have any part of their portfolio end up actually going to zero in that regard, especially if they're taking that kind of risk. So we can't have debt taking equity risk. So I think that's a role that debt actually plays. It's important for even the ecosystem to be a lot more mature about that and go. We've actually, when I was speaking to banks and several others, they've actually spoken about cases where the company's actually in the Series B, Series C. They go there and tell the bank, I raised my Series C, I actually want so much debt. Debt almost equal to the amount of equity that he raised. And this is a company that just started revenue operations, just started revenue then. He said, look, you have no cash flows coming in from operations that gives me any sort of comfort to end up actually giving you debt. So that's where the maturity also comes in for that. So I think debt does play important. That's why the venture debt guys that are coming in, it's a mushrooming market in India as of now, are taking over that particular place where they say, look, after the equity guys come in, for that matter, and when the company reaches a certain stage, we can take that kind of risk because venture debt, the model also is, you have your normal cash flows coming in from your lending business, etc. But the warrants end up giving you the kind of upside on the same. So that's why we've seen the kind of industry and a mushroom. Debt has a very important role to play, but it's contingent on the founder to understand when to inject debt, how to build up that track record of actually accepting debt. Because the moment you have a track record with them, 2 to 3 years of actually servicing your debt component, repaying the principal as well, the debt guys end up actually chasing you because they have a large amount of money that they have to deploy. And they're looking for quality customers who can end up actually repaying that. So we don't have assets also for the same. You need to have a strong operating model and strong operating cash flows to give them the kind of comfort to say, even though we may not be able to pledge any sort of physical assets that you have, your inherent business model and your cash flows are strong enough to end up actually covering the kind of servicing of this credit that we actually need. So I think that sort of meeting should end up actually happening. And both the debt guys as well as the founders need to spend a lot more time together, just engaging with this, understanding each other a little better before then. So at 314, we actually have a team that ends up actually helping our companies raise debt as well. And when we start off also, we spend an immense amount of time just getting both of them comfortable, getting the debt guys comfortable, getting the bank comfortable with the financial model that they have, getting the founders also comfortable that how you raise equity versus how you raise debt are very, very different parts. They don't care about the TAM and all these kind of things you end up actually raising equity on. They look at your business, the nuts and bolts of your business. How much cash can you end up generate a pass? What is the consistency of cash flows that you have? And then they end up taking credit underwriting decision on that. But as you build up that track record, within a year and a half of us actually funding them, we make sure to start these sort of, and we start with a small amount. Even though it's a very small amount, they build up that track record and slowly over time, the banks end up getting comfort in that. And they take independent decisions. Let's actually increase this particular part. If we have more cash in the bank, for that matter, you're turning profitable, end up actually giving a lot more on that. So it's a flywheel. It's that sort of inflection point and the J curve that happens. But you have to go through the entire low part before you hit the inflection point and end up actually scaling up to a large extent.
Okay, and this is a question I asked everyone on my podcast. If you were to start a company today, what would it be?
That's actually very interesting. That's actually a very interesting question. I think so. Cross-border is one place that's actually very, very interesting for that regard, because cross-border is actually this perfect interplay of business needs, Byzantine regulations that someone needs to actually end up condensing and create a tech solution for that matter, as well as giving comfort during the entire transaction chain. So I think in the cross-border space, especially when it comes to enabling exports, there are already very strong tailwinds that are actually pushing a number of these companies forward itself. There is an immense amount of appetite that's there. But there's always a gap when it comes to operations. There's a gap when it actually comes to trust. So I think that's going to be one of the most lucrative areas that we see. And if you have a tech solution that's integrated from end to end, similar to how Stripe actually did that for the payment gateways, we can accept money almost from across the entire world for that matter. Having that sort of out of the box solution for exports is something that won't only apply in India, but apply in the rest of the world. Every government across the world is looking to increase the share of exports. But there's operational friction that's built in because of regulation, built in because of the lack of aggregation that ends up actually having there, and the lack of trust that's actually there in the system. So I think the ability to solve these three elements does actually make a fantastic use case for people to end up actually doing that. And this also plays in the entire India field with regard to utilization UPI, playing into the India story as well. So I think that sort of thing is something that's very exciting to us. Thankfully, we actually found a great company to end up funding in that space. It was actually doing all this and more. And we're very, very happy with that, happy with the kind of investment. But if we didn't have that investment and I was actually an entrepreneur starting up, I think this is something you can end up actually looking at to a large extent.
Very interesting. And if you were a 22-year-old freshly graduating out of college, what would you be doing today?
I think when I graduated from college, slightly after graduating college, when I started 314. So if I was actually graduating as of now, I think I could do the same thing. End up actually starting a VC fund, go through the entire grind, the slog of raising your first fund, your second fund, building up track record, and then slowly end up actually building a lot more value.
Let's dive deeper into that. So like it's kind of rare that someone freshly graduating or, early in their 20s will actually go out and set up a fund. How exactly, how do you even dare to do that? And how did you pull it off?
So that's it. So it's one of the, this is one thing when we were starting up, Pranav and I were starting up 314 also, we actually look back and said, look, if you look at the entire startup in the entrepreneur ecosystem that's there in the country, the average age of most of these entrepreneurs anywhere in their late 20s, early 30s for that matter. Most of the target market they end up actually going through is also within that age gap itself. But the people funding these sort of ideas are usually in their late 40s, early 50s, some of them in their 60s as well. We can't have a generational gap that exists between the founders, the market, as well as the investors. That actually became an area that's actually ripe for disruption, because if you as an investor can develop a peer of the founder, you can develop that kind of personal rapport with them. It's not a school teacher, school kid kind of equation that we've actually seen unfortunately happen in a number of these areas. And you also within the consuming class or the target market for these kind of startups, you have understandings into the market, which are not theoretical, but actually practical. You can have a rapport with them, and it does actually give you the kind of ability to do so. And I'm firmly of the opinion that given the fact that, venture is not something, what worked in venture 10 years ago is not going to work as of now. What works as of now is not going to work 10 years later. So if you have 20, 30 years experience, mind you, some of the experience ends up actually becoming legacy baggage as well as biases that are actually inbuilt. And a market that ends up changing every 2-3 years, you have to end up actually keeping yourself refreshed. And mind you, in early stage investing especially, and all this is for early stage investing, there's a large amount of personal energy that you need to end up having to actually massive entrepreneurs, build an entire portfolio, make sure to have constant, continuous monitoring and oversight across the entire piece. So we looked at these sort of elements, and Pranav and I were actually discussing, trying to figure out, we wanted to work together, or we didn't have the kind of sibling rivalry that most people end up actually assuming that siblings end up having. But we said, look, we actually do have a set of skills that are actually mutually exclusive, but collectively exhaustive. He actually went to Stanford, he graduated at Stanford, worked in a startup, scaled it from 0 to 150 million, vested his options, was coming back. I finished my CA. I actually finished my CA, worked in a bespoke firm, understood the entire audit process, some of the process from end to end. And we said, let's actually pool in our ability together, pool in our talents together. Let's actually try raising capital, which is the fundamental part. So we went to friends and family, ended up actually putting that, started a very small fund in that regard, kept the fee base exceptionally low, didn't pay ourselves anything for the longest period of time. I think we actually started taking a salary by about 2020, 4-5 years into our entire journey itself. So we had that kind of thing, and we said, look, this is a slog that happens, but if you truly believe in the J curve, and you can make those kind of sacrifices initially, I think this is a fantastic space to actually be in, because you can have outsized impact on the entire ecosystem. So that's actually predicated. If you can, and the one thing that's also important in this is, it's great in theory to end up starting these kind of firms that matter. But what's going to be important is the role that you as a fund manager and a founder end up playing. We took immense amount of time to understand the entire regulatory landscape, understand the entire investing landscape, went and actually met some of the fund manager by ourselves, put ourselves out there in events, went and hustled our way through, and put in a large amount of effort. This is not, even though this is an industry where the prevailing wisdom is outsource almost every element of your activity, we took a contrary stance and said, let's actually insource all of it. So this greater element of risk that was actually there. And that insourcing helped us to actually run the entire firm, get a team that's also young, with zero venture experience for that matter, and build up the entire culture from scratch. So it took tremendous amount of entrepreneurial risk in those early days to end up actually getting that through. And now we manage over 500 million. We're still amongst the youngest firms in terms of the average age in the entire country, for that matter. We have large institutions who also backed us as of now. And it was a tremendous slog. So I think if you can, the best time to end up actually doing this is actually when you're much younger and you have that kind of energy, and you don't have the kind of, I would say, you don't have that kind of legacy baggage that actually says that, oh, I can't do this, I can't do that. That's what happens. As you grow older, even though the experience actually comes through, the experience actually ends up actually dimming some of the entrepreneurial zeal that you need to end up actually having for this. So I think that's how we actually put it. And because we ourselves end up putting money into our own fund for that matter, our trousers were literally nailed to the mast on that. So it was a great personal incentive to end up actually making this work and getting that through. And that's how we started 314, started going that through. I said, so I think we also want to be, we actually want to be proof that it's not that hard. It is hard to end up doing it, but it's not impossible. And made those kind of sacrifices. You can actually start off small and put in the kind of personal effort to help creating these companies. Because in early stage investing, it's very hard to do this for a late stage fund or a growth stage fund for that matter. There, the experience and everything ends up actually making a tremendous difference. Of that, you need to actually know how these larger companies end up operating. But in the place of new asset creation, you have a blank canvas within which you can end up actually working. I think that sort of thinking held us in good stead. I'm very happy to see even as of now, there are other fund managers who are coming up and say, look, because you guys managed to do it, we also got confidence. We were sitting on the fence. We also started doing that. And we started off very, very small. We were amongst the smallest funds I think we started in that entire vintage for the same. But we just kept at it, kept building at it, building a rapport with investors. And slowly people start saying, great, you guys actually have a program that works. Why don't you actually put some money behind that also? Similar to how a person starts a company, right? You start off with small, friends and family, raise a small round, you prove your thesis out, go attract large amount of money and doing that. Starting a fund is actually the same way as actually starting a company. The only difference is rather than having operational influence, especially with the portfolio companies, you have to space and you have to take undue amount of involvement from your side to convince the founders to end up actually making certain kind of changes, battle test their assumptions, give them data to help them validate some of what you end up saying, and actually win the argument on the basis of merit. I've actually seen some other investors say, do it because I told you so, I have 20 years experience as more than what you have, etc. It's never a call to authority to actually end up convincing. Right. So I think that kind of model has actually held us in very good stead and does actually show that it is possible to end up actually making these sort of firms or creating this sort of value as a fund manager itself, even though you end up starting far earlier for that.
Very interesting and very inspiring. Thanks a lot for this conversation, Siddarth. Lovely chatting with you.
Likewise, sir. Perfect. Thank you.